Question 1. Which of the following statements best describes the requirements for insurance producers in California under the Insurance Code? A. Producers are only required to submit annual reports to the California Department of Insurance, CI. B. Insurance producers must maintain their licenses through continuing education and adhere to ethical standards. C. Producers are exempt from continuing education requirements if they have been in the industry for over 10 years. D. Producers may engage in unlicensed activities if working under the direct supervision of an insurance company. Answer: B. Insurance producers must maintain their licenses through continuing education and adhere to ethical standards. Explanation: under California law, insurance producers, agents, brokers, etc. must meet ongoing continuing education requirements to maintain their licensure. They are also held to ethical conduct standards outlined in the California Insurance Code. Violations of ethical standards can result in penalties or license suspension. Producers are not exempt from requirements, regardless of experience, and they must be licensed to engage in insurance-related activities. Option B accurately reflects the legal obligations of producers. Question 2. Scenario: Mr. Thompson recently applied for an insurance license in California, but he has a prior felony conviction for insurance fraud. Based on California law, which action is most likely to occur regarding his application? A. Mr. Thompson's application will be automatically approved as long as he provides a bond. B. The California Department of Insurance, CDI, may deny Mr. Thompson's application due to his felony conviction. C. Mr. Thompson will be required to pay an additional fee, but his application will be processed as normal. D. Mr. Thompson's application will be approved, but he will be restricted to working with specific insurers. Answer: B. The California Department of Insurance, CI, may deny Mr. Thompson's application due to his felony conviction. Explanation: according to the California Insurance Code, individuals with felony convictions, particularly for offenses such as insurance fraud, are subject to potential denial of their insurance license application. The California Department of Insurance has the authority to evaluate the criminal background of applicants, and certain felonies may disqualify them. Felony conviction for insurance fraud is a significant disqualifying factor under the law. Option B correctly reflects the potential outcome of Mr. Thompson's application. Question 3. Which of the following is a key requirement for an insurance company to comply with California's rate regulation under Proposition 103? A. Insurance companies must obtain prior approval for any premium rate changes from the California Department of Insurance. B. Insurers may change rates without needing approval as long as they notify the public 30 days before the change. C. Premium rate changes can be implemented without justification as long as they are based on market conditions. D. Insurance companies are required to reduce premiums annually based on company profits. Answer: A. Insurance companies must obtain prior approval for any premium rate changes from the California Department of Insurance. Explanation: under Proposition 103, California insurance companies are required to obtain prior approval from the California Department of Insurance, CDI, before implementing any rate changes for most lines of insurance. The CEI reviews the proposed rates to ensure they are fair, reasonable, and adequate based on factors like claims experience, market conditions, and costs of operation. Insurers must submit detailed justification for rate increases. Option A accurately reflects the regulatory requirement under Proposition 103. Question 4. Which of the following practices is considered a violation of California's insurance regulations regarding ethical conduct? A. An agent recommending policy to client without disclosing the agent's commission. B. An agent offering discount to customer who purchases policy from their company. C. Producer charging fee for providing free insurance quote. D. An agent advising client to purchase additional coverage based on the client's personal needs. Answer: A. An agent recommending a policy to a client without disclosing the agent's commission. Explanation: under California law, insurance agents and producers are required to act ethically and disclose potential conflicts of interest, such as commissions, when recommending products to clients. Failure to disclose the agent's compensation constitutes violation of ethical standards and can lead to disciplinary action, including fines or license suspension. Options B, C, and D are permissible actions in California under certain circumstances. Question 5. Scenario: Mrs. Ellis is reviewing a health insurance policy that includes a pre-existing condition exclusion. She has A health condition that was diagnosed prior to purchasing the policy. What must the insurance company do under California law regarding this exclusion? A. The insurer can refuse to cover any health claims related to her pre-existing condition for the first 5 years. B. The insurer is required to inform Mrs. Ellis about the pre-existing condition exclusion during the sales process. C. The insurer may deny her coverage entirely due to her pre-existing condition. D. The insurer must cover her pre-existing condition after 6 months, regardless of any other policy terms. Answer: B. The insurer is required to inform Mrs. Ellis about the pre-existing condition exclusion during the sales process. Explanation: under California's health insurance regulations, insurers must clearly disclose any exclusions related to pre-existing conditions to the policyholder before the contract is finalized. Failure to disclose such information can result in penalties or regulatory action. While insurers may include exclusions, they must provide transparency in the sales process. Option B is in line with California law, while the other options do not align with consumer protection regulations. Question 6. What is the primary purpose of California's Insurance Fraud Prevention Act? A. To ensure that insurance premiums are evenly distributed across all policyholders. B. To provide regulations for the licensing of insurance adjusters. C. To reduce fraudulent claims and activities within the insurance industry. D. To eliminate the need for state regulators in overseeing insurance companies. Answer: C. To reduce fraudulent claims and activities within the insurance industry. Explanation: the California Insurance Fraud Prevention Act focuses on combating fraud within the insurance industry by establishing penalties for fraudulent claims, including those made by consumers, providers, and agents. It requires insurers to report suspected fraudulent activities and cooperates with law enforcement to investigate and prosecute fraudulent claims. Option C correctly identifies the purpose of the Act. Question 7. Which of the following would most likely be considered an unfair claims practice under California law? A. An insurer offering a reasonable settlement to a claimant shortly after receiving the claim. B. An insurer failing to settle a claim promptly after liability has been established. C. An insurer offering a higher payout than the policy limits for certain claims. D. An insurer informing the claimant about their rights to dispute a claim denial. Answer: B. An insurer failing to settle a claim promptly after liability has been established. Explanation: under California law, an insurer is obligated to handle claims in a timely and fair manner. If liability is established, the insurer must act promptly to settle the claim. Failing to do so can be considered an unfair claims practice and may result in penalties or other regulatory actions. Option B reflects a violation of claims handling requirements, while options A, C, and D are examples of fair practices. Question 8. What is the main objective of Proposition 103 regarding insurance rate regulation in California? A. To eliminate competition among insurance companies in the state. B. To ensure that insurance premiums are competitive and affordable for consumers. C. To allow insurance companies to set rates without any regulatory oversight. D. To regulate insurance company profits based on market share. Answer: B. To ensure that insurance premiums are competitive and affordable for consumers. Explanation: Proposition 103 was introduced to provide consumers with more affordable and transparent insurance premiums. It requires the California Department of Insurance to review and approve premium rates for most lines of insurance to ensure that they are not excessive or discriminatory. The proposition aims to protect consumers by ensuring that rates are justifiable based on insurer expenses and market conditions. Option B correctly captures the objective of Proposition 103. Question 9. Scenario: Mr. Adams is considering purchasing an annuity from a licensed producer. The producer does not fully explain the annuity's surrender charges or the terms of the contract. What legal requirement has the producer violated under California law? A. The producer failed to meet continuing education requirements. B. The producer failed to provide adequate disclosure of the annuity terms. C. The producer is not allowed to sell annuities in California. D. The producer did not provide refund period for the annuity. Answer: B. The producer failed to provide adequate disclosure of the annuity terms. Explanation: California law requires insurance producers to provide clear and complete disclosures about the terms and conditions of annuity contracts. This includes details about surrender charges, fees, and any restrictions. Failure to fully explain these terms is a violation of the producer's fiduciary duty and could result in penalties. Option B correctly identifies the violation. Question 10. What is the role of the California Department of Insurance, CDI, in enforcing solvency regulations for insurance companies? A. The CEI conducts audits of insurance companies' financial statements to ensure solvency and compliance. B. The CDI is only responsible for regulating the premiums charged by insurance companies. C. The CDI oversees claims handling practices, but not financial solvency. D. The CDI is responsible for investigating insurance fraud, not solvency issues. Answer A. The CDI conducts audits of insurance companies' financial statements to ensure solvency and compliance. Explanation. The California Department of Insurance plays a key role in maintaining the solvency of insurance companies. This includes reviewing financial statements, conducting solvency audits, and ensuring that insurers have adequate reserves to meet their obligations to policyholders. The CDI's oversight helps prevent insurer insolvency and ensures that policyholders are protected. Option A accurately describes the CDI's role in solvency regulation. Question 11. Which of the following is true regarding the licensing process for insurance agents in California? A. Insurance agents are not required to complete pre-licensing education if they have prior experience in the industry. B. The California Department of Insurance mandates that all agents pass a licensing exam specific to the type of insurance they wish to sell. C. Insurance agents are not required to meet continuing education requirements after obtaining their license. D. Agents may obtain multiple licenses without completing a licensing exam for each type. Answer B. The California Department of Insurance mandates that all agents pass a licensing exam specific to the type of insurance they wish to sell. Explanation. In California, insurance agents are required to pass a licensing exam that is specific to the type of insurance they plan to sell, such as life, health, or property casualty. Additionally, agents must meet pre-licensing education requirements and they must fulfill continuing education obligations to maintain their license. Option B accurately reflects the licensing requirements. Question 12. Under California law, which of the following is required when an insurer denies a claim? A. The insurer must provide a written explanation to the claimant detailing the reasons for the denial. B. The insurer must immediately refund the premium to the policyholder. C. The insurer is required to approve the claim within 60 days, regardless of the circumstances. D. The insurer can deny the claim without providing any written explanation. Answer A. The insurer must provide a written explanation to the claimant detailing the reasons for the denial. Explanation. California law requires insurers to provide a written notice of claim denial, which must include the specific reasons for the denial. This ensures transparency and allows the claimant to understand why the claim was denied and what steps they may take next. Option A is correct as it aligns with California's claims handling regulations. Question 13. What must an insurance agent do if they change their business address in California? A. Notify the California Department of Insurance, CDI, within 30 days of the change. B. Notify the policyholders about the change of address. C. Notify only the insurance company they represent. D. No notification is necessary unless the agent changes their name. Answer A. Notify the California Department of Insurance, CDI, within 30 days of the change. Explanation. California insurance law requires agents to notify the California Department of Insurance, CI, within 30 days of any change in business address. This is part of the ongoing licensing compliance to ensure that the CEI has current information on all licensed agents. Option A is correct. Question 14 scenario. A client has recently purchased life insurance in California, but after 4 months they wish to cancel the policy and receive a refund. What must the insurer provide according to California's insurance regulations? A. The insurer must refund the full premium without any deductions. B. The insurer must provide a refund based on the pro rata amount of the policy. C. The insurer must honor a full refund, but only within 30 days of purchase. D. The insurer must provide a refund as outlined in the policy's free look provision. Answer D. The insurer must provide a refund as outlined in the policy's free look provision. Explanation. California law mandates that life insurance policies include a free look period, typically 10 days from the delivery date of the policy. During this period, the policyholder can cancel the policy and receive full refund of premiums paid. Once the free look period expires, refunds may be subject to specific terms outlined in the policy. Option D accurately reflects the free look provision. Question 15. What is the primary purpose of California's Consumer Privacy Act (CCPA) as it relates to insurance companies? A. To provide consumers with greater control over their personal data and how it is used by insurers. B. To limit the amount of insurance premiums that insurers can charge consumers. C. To mandate that insurers disclose the details of their claims process to policyholders. D. To regulate how much profit insurance companies can make from premiums. Answer A. To provide consumers with greater control over their personal data and how it is used by insurers. Explanation. The California Consumer Privacy Act (CPA) gives California residents more control over their personal data, including how it is collected, stored, and shared by businesses, including insurance companies. Insurers must comply with these regulations, which include allowing consumers to opt out of data sales and request access to or deletion of their personal data. Option A is correct as it reflects the primary purpose of the CCPA. Question 16. Under California's Fair Claims Settlement Practices regulations, how long does an insurer have to acknowledge receipt of a claim? A. 7 days. B. 15 days. C. 30 days. D. 45 days. Answer B. 15 days. Explanation. California's Fair Claims Settlement Practices regulations require insurers to acknowledge receipt of claim within 15 days. This acknowledgement may be simple confirmation that the insurer has received the claim and is beginning its review. Prompt acknowledgement is important to ensure fair treatment for policyholders. Option B is correct. Question 17. Scenario. A policyholder in California experiences a loss covered under their homeowner's insurance. The insurer needs more time to investigate. What is the maximum period the insurer can extend the investigation period before making a decision? A. 30 days. B. 60 days. C. 90 days. D. 120 days. Answer B. 60 days. Explanation. In California, an insurer may extend the investigation period for an additional 60 days if they need more time to review the circumstances of a claim. This extension must be justified and the insurer must provide the policyholder with a notice of the extension. The insurer must make a decision about the claim within this extended period, making option B correct. Question 18. Under California law, what must an insurer do if it offers a health insurance policy with a network of providers? A. The insurer must provide a list of network providers to the policyholder. B. The insurer must guarantee that all policyholders can see any provider without restrictions. C. The insurer must disclose the cost of out-of-network services. D. The insurer does not need to disclose any information about the network of providers. Answer A. The insurer must provide a list of network providers to the policyholder. Explanation. Under California's health insurance regulations, insurers offering policies with network of providers must provide policyholders with list of in-network providers. This ensures that consumers are fully informed about where they can access medical care and the costs associated with using network providers. Option A is correct. Question 19. What must insurance agents do to comply with California's continuing education requirements? A. Take courses every 5 years to maintain licensure. B. Complete 24 hours of continuing education every 2 years, including ethics training. C. Take a new licensing exam every 2 years. D. Attend a live seminar each year to meet requirements. Answer B. Complete 24 hours of continuing education every 2 years, including ethics training. Explanation. California requires insurance agents to complete 24 hours of continuing education every 2 years to maintain their license. This education must include at least 3 hours of ethics training. Failure to meet these requirements can result in penalties or suspension of the agent's license. Option B accurately describes the continuing education requirements. Question 20. What is the insurable interest requirement in California for purchasing a life insurance policy? A. The policyholder must be related to the insured by blood or marriage. B. The policyholder must have a financial interest in the life of the insured. C. The policyholder must be a named beneficiary in the insured's will. D. The policyholder must have a prior business relationship with the insured. Answer B. The policyholder must have a financial interest in the life of the insured. Explanation. In California, the principle of insurable interest requires that the policyholder have a legitimate financial interest in the life of the insured. This ensures that life insurance policies are not purchased for speculative purposes. The insurable interest must exist at the time the policy is issued, and the policyholder cannot collect benefits from a policy unless they are financially impacted by the insured's death. Option B is correct. Question 21. What is the maximum fine an insurer in California may face for committing an unfair claims practice? A. $1,000. B. $10,000. C. $100,000. D. $1 million. Answer: C. $100,000. Explanation: California law imposes significant penalties for insurers found guilty of unfair claims practices. The maximum fine an insurer may face is $100,000 per violation. These penalties are designed to deter unfair treatment of policyholders and ensure that claims are handled fairly and promptly. Option C is correct. Question 22. Which of the following is true about California's law on unfair discrimination in insurance? A. Insurers are allowed to discriminate based on race if it is in the policyholder's best interest. B. Insurers may charge higher premiums to individuals with criminal history, but only if the criminal offense was not related to insurance fraud. C. It is illegal for insurers to discriminate based on the policyholder's gender, sexual orientation, or marital status. D. Discrimination based on policyholders' age is always allowed if it is supported by statistical data. Answer: C. It is illegal for insurers to discriminate based on the policyholder's gender, sexual orientation, or marital status. Explanation: Under California law, insurers cannot discriminate based on race, gender, sexual orientation, or marital status. This law is designed to ensure that individuals are treated equally in obtaining insurance coverage, regardless of these characteristics. Option C correctly reflects California's commitment to fair treatment in insurance. Question 23. Which of the following is an example of a pre-existing condition in California health insurance policies? A. A policyholder who was previously treated for diabetes. B. A policyholder who develops a cold after purchasing health insurance. C. A policyholder whose parents have a history of cancer. D. A policyholder who recently got married. Answer A. A policyholder who was previously treated for diabetes. Explanation: A pre-existing condition refers to any medical condition that existed before the policyholder purchased health insurance. California law prohibits health insurers from denying coverage or charging higher premiums based on a pre-existing condition. Option A describes an actual pre-existing condition. Question 24. What is the minimum liability coverage required for automobile insurance in California? A. $10,000 for property damage, $30,000 for bodily injury per person, $60,000 for bodily injury per accident. B. $15,000 for property damage, $30,000 for bodily injury per person, $60,000 for bodily injury per accident. C. $50,000 for property damage, $100,000 for bodily injury per person, $200,000 for bodily injury per accident. D. $25,000 for property damage, $50,000 for bodily injury per person, $100,000 for bodily injury per accident. Answer: B. $15,000 for property damage, $30,000 for bodily injury per person, $60,000 for bodily injury per accident. Explanation: California law mandates the following minimum coverage limits for auto insurance: $15,000 for property damage, $30,000 for bodily injury per person, and $60,000 for bodily injury per accident. These limits are designed to protect drivers and other parties involved in an accident. Option B is the correct answer. Question 25. What is the maximum amount of time an insurance company has to pay a claim in California after it has been settled? A. 30 days. B. 45 days. C. 60 days. D. 90 days. Answer: B. 45 days. Explanation: Under California law, an insurer is required to pay a claim within 45 days after it has been settled. This timeline ensures that policyholders receive timely payments after their claims are resolved. Option B is the correct answer. Question 26. In California, which of the following is required for an insurance company to use a credit score to determine premiums? A. The company must inform the policyholder about the use of their credit score. B. The company must obtain the policyholder's written consent before accessing their credit score. C. The company is allowed to access the credit score without informing the policyholder. D. The company may not use a credit score to determine premiums under any circumstances. Answer A. The company must inform the policyholder about the use of their credit score. Explanation: California law requires insurers to notify policyholders when their credit score is used to determine insurance premiums. Insurers must be transparent about how credit information impacts premium calculations. Option A is correct as it reflects the disclosure requirement. Question 27 scenario: a California homeowner purchases insurance coverage for their property after a fire damages their home. The insurer initially denies the claim, citing policy exclusions. The homeowner disputes the denial. What must the insurer do next under California law? A. The insurer must immediately issue a refund to the homeowner. B. The insurer must reevaluate the claim and provide a written response to the homeowner's dispute. C. The insurer must immediately issue settlement based on the homeowner's assessment. D. The insurer is not required to respond to the dispute unless the homeowner takes legal action. Answer B. The insurer must reevaluate the claim and provide a written response to the homeowner's dispute. Explanation: under California law, if homeowner disputes the denial of claim, the insurer must reassess the claim and provide written explanation of the reasons for either upholding or overturning the denial. This is part of the claims handling process to ensure fair treatment. Option B is correct. Question 28. In California, which of the following is a requirement for an insurance agent to sell disability insurance? A. The agent must be licensed as a health insurance agent. B. The agent must have a special designation in disability insurance. C. The agent must only complete a basic insurance course. D. The agent must pass the same exam as life insurance agents. Answer A. The agent must be licensed as a health insurance agent. Explanation: in California, to sell disability insurance, an agent must be licensed as a health insurance agent. This license ensures that the agent has the necessary knowledge and training to handle disability insurance policies properly. Option A is correct. Question 29 scenario: a California policyholder's home is damaged due to a burst pipe. The insurer sends an adjuster to assess the damages but takes no further action for over 60 days. What should the policyholder do next under California law? A. The policyholder must file a complaint with the California Department of Insurance. B. The policyholder must wait another 30 days before taking any action. C. The policyholder must hire a lawyer to sue the insurer for delay. D. The policyholder must contact the insurance company directly and request an update. Answer A. The policyholder must file a complaint with the California Department of Insurance. Explanation: if an insurer delays the claims process for more than 60 days, the policyholder may file a complaint with the California Department of Insurance. This helps the policyholder seek further action and ensures that the insurer complies with state regulations regarding claims handling. Option A is correct. Question 30. What is required for an insurer to cancel a homeowner's insurance policy in California? A. The insurer must give the policyholder 10 days notice if the cancellation is due to non-payment. B. The insurer must give the policyholder 60 days notice for all cancellations. C. The insurer must provide a full refund if the policyholder cancels the policy. D. The insurer may cancel the policy without any notice if the policyholder files a claim. Answer A. The insurer must give the policyholder 10 days notice if the cancellation is due to non-payment. Explanation: if an insurer cancels a homeowner's insurance policy due to non-payment, the insurer must provide at least 10 days notice to the policyholder. This gives the policyholder an opportunity to pay any overdue premiums or address the issue before the policy is cancelled. Option A is correct.